Hello, welcome to a video on how to record a loan payment in ProLedger Online. In this video, we're going to show you three different methods that you could use, and as long as you understand the pros and cons to each, they can work for you. So let's look at them one at a time. The first method is to simply record the entire loan payment as an expense. So step number one, we're going to create a loan expense category in the program, and we're going to show you how to do that in a second. And secondly, you're going to record the payment as an expense. So pretty straightforward. But just remember, at year end, you're going to use the interest portion only for doing your taxes. Assuming that you have a loan expense for your business, the interest portion is the only part that's deductible. So at the year end, just remember you can't use the entire expense on your ProLedger statement, just the interest portion when you do your taxes, right? So just keep that in mind, and this method can be really simple, and you can kind of keep an eye on your cash flow without making it too complex. So basically, as you can imagine, I'm just going to show you the entry. Basically, I go into setup, I go into expenses, and I create, in this case, I created an expense category called Loan A, or whatever you want to call it. When you go in there, just choose the default account for where the payment's coming from. And do you want to show this on the financial statement? You can choose yes or no, and then you'll be set to go. So then go back to your records. And when you look at the actual entry, it's just choosing the expense. The expense category is Loan A in this case. Is it business related? What's the account that it's coming from? I just put a simple description in here, but you could just use monthly payment or whatever you like if you want the description. And the amount is here. Okay, so that's really all there's to it. And then when you look at it on the report, it just comes up as an expense on your income statement as a normal expense. And that's the end of it. So as I mentioned, the thing about this method, just remember at year end to make the adjustment for tax time. All right, let's look at another method. You can record the loan payment as a transfer. Now this is a little different because if you do this method, you're not going to see anything on the income statement because it's simply going to be recorded now as movement of money, let's say from your checking account into your loan account, and you're going to record the entire payment simply as a transfer of funds. Okay, so the payment will be recorded in ProLedger, but it just won't show up on your income and expense statement. Now, if you rather use this method, again, at the year end, just make sure you make the interest portion of that loan payment as an expense on your tax time. So, and again, this will also work for you. The only difference here between method number one is that this particular method, nothing shows up on your income statement. So let's take a quick look at that one. So if I'm going to go back and let's just bookmark the second method here, and then I can just show you this by itself. Okay, so here you go. So now we're going to transfer. And when you use the transfer method, you actually have to make two entries. You see on the right side, I got two entries here. On one hand, we're going to transfer money out, let's say of our checking account, let's say it's $100. And you're going to transfer money in to a loan account. So one thing I'll mention here, to use this method, you do have to go in now and set up a new, rather than an expense category name, you're going to set up an account name. So let's go back to setup. Let's go to accounts. And you see how I created an account name called Loan 1. And let's say the loan balance was, let's say the loan was for $1,000. What I would do here is use the negative 1,000. Use the minus sign at the front of that number. So that shows that it's a loan. And then when you transfer money into this loan account as a positive number, that loan balance will drop. Okay, now this works just fine, except in this case, as you can imagine, there's interest on the loan probably, so it won't quite work that exact. But nonetheless, it'll be a record of the loan payment, and you'll have some record of it. So that's another simplified method. All right, so let's take a look at method number 3. Now with method number 3, this is going to be the most exact way to do it. We're going to record each loan payment with its corresponding principal and interest portion separately. So the first step, this takes a little more effort, but it's more precise. So the first step is we're going to create a loan expense category, just like we did in the first method. And then the second step is we're going to create a loan account as we did in method number 2. And so we're going to, with each loan payment, we're going to record the interest portion of that loan payment as an expense. And we're going to record the principal portion of that payment as a transfer into the loan account. So for this particular method, you will have to have a breakdown of the payment portion of interest and principal each and every time you do an entry. And so that'll be the one thing that you'll need to be able to make this work. Let's take a look at that method. So I'm going to go back to all entries, and we're going to bookmark the third method here just so we can just show you how that works. So let's just go over here. It's this one. Okay, I'm just going to show the bookmarked entry, and that's this one. So in this particular case, let's open it up. And you see there's actually 3 things that we did here. The first step, you can see here, here, and here. Those are the 3. For a $100 payment, this is how this is going to work. Let's say the payment's $100. And let's say out of that $100 in payment, the first, the $70 is interest, let's say, and $30 is principal repayment. So what we do is the first entry in this multiple entry scenario is we record the $70 interest expense payment. So we expense this to loan A as the expense. I could have changed the name of this to loan A expense to be more precise, but let's say the expense category is called loan A for our example. So I'm basically making a payment here to record just the interest expense on that one payment. Once we did that, and then we add another entry to this multiple entry scenario. And this is where we record the principal part of the payment. And when we do this, we're going to transfer money out of the checking account, the extra $30. Remember, we actually spent $100 in total, right, for the monthly payment. So the 70 we recorded as an expense out of checking, and then the 30 we recorded as a transfer out of checking. So these two combined equal 100, right, which is your total payment. Then we're going to do a third thing. So you transfer $30 out for the principal, and you transfer $30 in to the loan account, right? We set up an account name with a negative number in it. So we're going to transfer into that loan account. So anyway, when you do this, you're going to end up recording the interest as an expense and the principal as a transfer against the loan balance. So this is the most precise way to do it. And it's going to lower your income by $70 because you're only expensing the interest, which is the proper thing to do. So let's just save that. And you can see how this works out on the report. So we have a negative $70 for the interest expense, okay? And then when we go into accounts, you see the $900 loan balance, sorry, the $1,000 loan balance had $30 applied to it. So now our new balance is $970 because you've only paid $30 principal, right, on that particular payment. So it just brings down the balance by $30. So everything works. And, if you want to use method 3, just remember you're going to have to follow these 3 steps exactly, and it'll work out just fine, but you'll need your breakdown of your interest and principal each month. One thing I will add, that no matter what method you use, method 1, 2, or 3, when you're finished making the entry, instead of recreating this from scratch every time, you can use this copy feature at the right hand side just to make a copy of it, the entry. So if I click copy and submit it, then I'm going to have a second identical entry, and now all I need to do is go in and just adjust the amount of the interest or principal amount and that sort of thing. So that's an easy way to do it. And of course, there's even a third way. If you set up the payment, let's just quickly do one here. You can use the repeating entry feature also. So let's say it's a $100 payment every time, and it's on the first of every month. So you can just choose this method. And let's say you want to record the payment for April 1st. And then you can do another one for May the 1st. etc., until you, let's say you do 1 year at a time, or for the whole amortization of the loan if it's a 3-year loan, whatever you like. But just remember, in this method, you might want to set this up as a payable, because because you're recording entries into the future, those payments haven't been made yet. So you might want to later, when the payment actually gets made, you can change this from payable, let's say, to checking, or wherever the money came from. So an extra little tip to speed things along on these loan payments, since they're repetitive. So thanks for tuning in. I hope you found that helpful.